Top of the morning, back at it again with another one. And today we're looking at the GBPUSD. I just recorded an episode, but for some odd reason it didn't save. So I'm just gonna run through it again. Hopefully, I can get through the points as clearly and concisely as I did in the previous video. And yeah, let's get into it without wasting any other time. Obviously, the model that we're using or the approach is we are looking for continuation patterns. So trades that continue in the direction of the larger term trend relative to a dealing range that we're looking at. I don't want to use too many fancy words, but in essence, we're looking for a continuation pattern. For the bias, we start on the weekly time frame and we look at where we've come from versus where we are now and comparing that to where we could potentially go to. Price came down and tapped into this weekly fair value gap over there. We tapped into it and closed higher, as you can see from last week's candle. You can see there, and then this week's candle obviously is reacting how it's reacting. So the idea is for this internal range liquidity to allow us to load up to ride it all the way up. Currently, what I'm looking at is here by this green line, the low of this down close candle. That's the ultimate like level I'm looking at price to hit up to. If it goes up into this region here, then oh dope. But I do not expect it to do that, as this looks like a balanced price range. But anyway, we looked at the weekly. Bias is bullish from this imbalance towards the high. Let's go to the daily. Daily, what we ideally want to see is the daily bias at the time also being in line with the weekly bias. And for the daily time frame, we can see price reacted off of that weekly fair value gap. We did what we did. Yesterday we didn't have this candle, and this candle here was still around about in this area. So price opened and traded a bit lower. If you're familiar with the power of three concept, you know exactly what that means. For the machine to go up, it needs to go down first. For the machine to go down, it needs to go up first. And that wick there, that's what I'm talking about. That wick there, that's what I'm talking about. Open price, manipulation up, distribution down. Open price, manipulation down, distribution to the upside. That's particularly what we're looking for. And that also gave us further bias to say that, okay, on the daily time frame as well, we're bullish. We're looking at that dealing range low and that dealing range high. Internal range liquidity here to take us to the upside. Once you have the bias for the weekly and the daily, and they both are in line, we can then go down to the 4 hourly time frame and look for our context. Context wise, very easy, especially since we have the draw and we have an idea of the direction in which price is more than likely to go to. We are looking at the context. Context wise, like I said, it's a continuation. So, internal range liquidity targeting external range liquidity. The dealing range we were looking at was that low of Monday to that high of Monday. The low of Monday took out some sell side liquidity, giving this a strong bottom. We pushed up, left a high, relative equal highs over there, and then we proceeded to press to the downside. As we expanded up after taking out sell side liquidity, we opened up a fair value gap on the 4 hourly time frame, coupled with an order block, making this a high probability area of support. We then waited for the London Open kill zone, which is between 2 a.m. to 5 a.m. Eastern Standard Time, for us to take an entry, which is when we found price hovering around that PD area on the 4 hourly time frame. Let's go to the 1 hour now, since we have our context, which is external internal range to external. 1 hourly time frame, we're looking for the PD area for us to enter off of. And like I said, we're looking at that dealing range low to that dealing range high. We have an internal range of liquidity, which is a 4 hourly fair value gap, which exists inside the range that we are trading. Hence, internal range liquidity. An order block could have also offered us internal range liquidity, but for this particular trade, we're looking at a fair value gap. Point of inefficiency. You see where price pulls to the upside, there's gaps left open of inefficient price delivery. Price will often come back down to fill out those areas and then continue in the direction of the initial impulse. This phenomena is what we are using as our edge, or rather, in simplistic terms, internal range liquidity to external range liquidity. We had this leg here manipulating down, taking further sell side liquidity, filling out that 4 hourly imbalance, and opening up a fair value gap, which was initially bearish. Once price closed and above that hourly imbalance, we then got an indication that price is indeed bullish, and we're just waiting for price to come back down, which you can see with this candle. Let me just zoom in a bit more. You can see with this candle here, price tapped down, tapped the hourly inversion fair value gap, tapped that 4 hourly fair value gap again, the purple one, before pushing to the upside and targeting the high there on Monday, which is our external range liquidity. Very easy, very beautiful, very simple. Just gonna look at the 15 for the Chias. Very beautiful. Gave us a re-entry opportunity as well, and then we were gone. Another re-entry there. You can see if we're looking at that high to that low now, that's internal range liquidity. That as well. Why did we use this one here? There's an order block there. Support, support, hit that, push up again, take out that high. We opened up another range here, or another imbalance, came back down to fill out that imbalance there, tried to push up again, took out the high. Internal range to external range, internal range to external range. That's it. That's all you'll ever need. I want to be sure to save this video properly. I don't need it not being saved again. And yeah, man, I just hope the logic is clear, easy for everyone to follow, and you are able to see roughly what we do on a day-to-day basis. It's all about internal range liquidity to external range liquidity. Once you have your bias, once you have your context, and once you have your fair value gap or PDRA that you're looking to enter through, the rest is history. You then just can give it an extra boost by using the right timing, by entering during a kill zone. Perhaps if you're a silver bullet trader, you trade between 3 a.m. to 4 a.m. Eastern Standard Time, 10 a.m. to 11 a.m. Eastern Standard Time, or 3 p.m. to 4 p.m. Eastern Standard Time. Well, whatever element of time it is that you personally use, if that's something that you make use of in your own personal trading methodology, it can definitely give you a high probability setup. This framework or approach will give you the cookie cutter that you need, that you can rinse, repeat, rinse, repeat, rinse, repeat, rinse, repeat. Once you have this cookie cutter, it's just a matter of money management. Per every stop loss, risk a fixed amount of your account and risk at least 2 times what you're risking. Then it's just a thing of letting time do its thing, letting time do its thing, letting time do its thing. And before you know it, you'll be consistent. It's been a long road, but we're still pushing. Thank God for the skill.